Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs data and what it means for mortgage rates. Logan, welcome back to the podcast.
Sarah Wheeler, we're back from Nashville, and did we kill it or what?
It was a great event. Meridian Link. Yeah, you gave a great economic talk, had the crowd eating out of your hand as per usual. It was really good and very timely.
Listen, when you get asked to be the, keynote speaker next year, 2 minutes coming off the stage, then you know you've done well. And I'm telling you, man, live events, Sarah Wheeler and myself, the nerd tour going around the country. Caroline couldn't be there this time, but we have a lot of fun. And especially if you've never heard me speak, or my economic presentations are designed to be very informative, but very entertaining. So my fellow economists who tend to be a little bit stale, we don't want to go that route. We want to make economics as fun as possible so all of us can tell Uncle Dave that it's not Housing 2008 Thanksgiving.
Yes,
that's the
we
goal.
had somebody come up after your talk as we were walking out, and he was like, "That was better than television." We're like, "Well, there you go. We'll take it. More entertaining than TV." Logan Mohtashami. Okay, lots to talk about today. Obviously, Jobs Friday.
Okay, so last month when I wrote that labor market article, right? Again, for me, it's always about economic models. We highlighted all the labor data models going up from April 7th, 2020 to last month. Last month, we said the wage growth data is now getting into an area where it gets more interesting, right? And the Fed talked about, we don't really want to attack wages. We made the premise, 3% wage growth, 1% productivity. The Fed doesn't really believe the strong productivity numbers. Some people make the case, well, it's immigration that's really boosting productivity. I mean, Australia and Canada are having, immigration, and those countries aren't having productivity data that looks like ours. So the Fed doesn't really put too much weight into it. But if that's the case, then they want wage growth back down to 3% pre-COVID. And they can live with the realities of productivity being around 1%. So today, wage growth, even with some people thinking the minimum wage in California, that would boost up wages. Maybe that filters in a little bit more next month. Below 4%, we have a 3.9% handle. If we start getting below 3.5%, we could start doing the countdown of the Fed's complete model of the labor market getting back to pre-COVID is then completed, right? Because Jobs Week, and Jobs Week means job openings and quit ratios, and job openings, it got as high as 12 million down to 8.5 million. So we've always talked about this for the last, 2 years. The Fed really wants that at 7 million. Quits ratios, which is really key, fell again. The quit ratios, 2.1%. Quits ratios being high at 3%. Bad. People making more money. Bad, bad, bad. Bad Americans. You can't have that. Right? So the quit percentage is falling. Wage growth is falling, right? Quits percentage pre-COVID levels, hires pre-COVID levels. The labor market is no longer tight. I know President Bowman of the Fed says the labor market's tight and, people are coming into this country and wages might accelerate. No, wage growth is slowing down with the quit ratios, job openings, everything trends together, right? It just moves all together at once. It's hard to reaccelerate something like that very quickly. So we are getting to the point to where we could be under 3.5% wage growth this year, right? I was kind of looking at taglining it maybe early part of 2025, but these are positives because the Fed becomes more of a dual mandate Fed. And that's the key, because if they're a one mandate Fed, right, and CPI inflation was at 9% in June of 2022, the headline is at 3.5%. PCE inflation that Jerome Powell talked about was a little bit above 7% at its peak. We have two handles on that. The PPI inflation was double digits. We have two handles on that. So there's progress made. The more they could be in the dual mandate, the better it is for housing going out in the future, because we've had, such a increase in mortgage rates and elevated mortgage rates for a while without any kind of retracement and holding it, right? We've had 2 times now the rates have fallen, demand picks up, people get excited and then shoots right back up then. So once we get a little bit more softness on the labor data in terms of wage growth, we're finding that, kind of getting that to the end of the tunnel. And hopefully we could get a pivot before the labor market breaks in terms of jobless claims rising. But it was a really fascinating week with the Fed and the labor data and everything, because if you read my job articles, right, connect the dots. I'm connecting all the dots for the last few years, right? Years 2020 to 2024 were always going to be my baby. So I have to make sure to get everything in there. It starts to make sense.
It does start to make sense. So was it last week, 2 weeks ago, you talked about landing the plane? I think you said, hard landing, soft landing, no landing, right? What is this? How does this play into that whole discussion?
So this technically, if this continues, right, it can be a soft landing. The hard and soft landings really depends on what people kind of interpret that as. Mine is, if the unemployment rate gets above 4.5%, it's a hard landing, right? The Fed forecasted a hard landing last year in 2023 because they had the unemployment rate getting there and higher. Here, because we're seeing the tight labor market become less tight, the next stage would be job losses. Now, there's a lot of people out there, and I know a lot of people in the mortgage industry are listening to people that said the labor market isn't that strong, and because we all want to see rates go down for business to pick up. You have to be careful on who you listen to on the internet, especially if they're stock traders. Okay, so there are some conspiracy theories about jobless claims data and everything. Listen, when it's a job loss recession, ladies and gentlemen, it'll be so easy to see. It's been the same thing since the Peloponnesian War. Jobless claims rise. The job reports are not positive. They're negative. They're going to be negative a couple 100,000 easily, because we have over 158 million people working now. We have a country at 342 million. So we're not there yet. What we are is the labor market is less tight. It's getting softer, right? Less tight and getting softer is not breaking. Breaking is jobless claims rising, and we have negative reports. Now, even with the 6-month average, I take the 6-month revised average, the labor data is still beating my estimates. And I set those targets out. I said, eventually when we get to 157 to 159 million jobs, job growth should slow to about 140 to 165K, right? This is where we should be. If there was no COVID-19, right, the makeup demand, all this, we should be here. We're not there just yet, right? 6 months, the headline report came in at 175,000, but if I average out the last 6 months, it's about 243,000. So we're getting to that area. And once we get there, that means we're back to normal. And then when you're back to normal with a less tight labor market, then in theory, the unemployment rate is actually really higher than what it is right now, because it's harder to find jobs, right? So that is a viable case. But breaking means jobless claims rising and we lose jobs. Trust me, the bond market will go lower before the Fed, right? So we've already put one rate cut into the system, and it's already 1 month or earlier. We're going in September now instead of December. So economics is not static. You have to follow the data. And now people were talking about rate hikes to now, okay, when's the rate cut coming? So it moves like crazy. So don't get stuck into one mode and just follow the data, but follow the trend, right? The trend is your friend there. The trend is heading one way, right? And we just want the Fed to land the plane, right? And there's so many what I call stock traders, or people that want to see rates higher so they could break something and get a recession so they could blame the Fed for that. I'm hoping that a little bit of discipline, that's why we don't listen to stock traders, don't listen to them. Here we're talking about, if we can just progressively move forward, then we'll be okay. But again, I don't believe this Fed is that. The Fed would feel more comfortable if the labor market starts to break. And then they go, oh, we have to do this, dual mandate, we have to cut rates. And like Powell said, if the labor market breaks or gets weaker, we have to cut rates faster. So I'm hoping we don't get to that point, but this is where we are. We're heading in the right direction. It's just slower than a lot of people thought, because a lot of people were thinking recession in 2022, 2023, 2024. We're not there yet.
Not there yet. Okay, so unemployment is at 3.9%, up a little bit from 3.8%. But as long as it's under 4, they're not going to, they consider that fine.
Now, here's an interesting thing. Powell talked about this, that if the unemployment rate goes up a few basis points, it doesn't really change their model. Well, guess what? It went up a few basis points already, So that's correct. I think we're 3.4% was the low level. So naturally, I just think they follow claims data. And they even said this, Jerome Powell said, about 2 meetings ago, well, we follow jobless claims data and it was going lower. Okay, whatever everyone thinks about the jobless claims data, that's fine. That's what they follow. Job openings is what they follow. So the job openings data is actually no longer tight. If there's any Fed member who's telling you the labor market's tight now, man, they're smoking something good. Powell's gone to the, Grateful Dead concerts a little bit too much, right? So we don't have a tight labor market in that context, but we don't have a breaking market. We want to kind of get things so things don't break. I've just never been a Fed pivot person because the history has shown that this kind of soft landing is very tricky. And the longer they stay restrictive, remember, their own models are restrictive. Doesn't matter what I think or anybody else's thinks. Their Fed funds rate is elevated from where core PCE is. That's why they keep on saying they're restrictive policy. So we take the data 1 week at a time, 1 month at a time, but we follow the bigger trend. And the trend is, okay, we're kind of getting to a better area for them. And that's what I'm encouraged about. That's why last month's jobs article talked about wage growth. Let's all start talking about wage growth data because we're now getting back to where we could be 3% wage growth, 1% productivity. The Fed should be like, okay, this is doable.
Your model calls for what, 323,000 jobless claims?
Jobless claims getting to 323,000 and breaking above that is a recession, right? So that's why we don't talk about that. The 6 recession red flags, even though they were all raised, the 5th flag came down after November 9th, 2022. When we're all full up, we will watch to when claims break. So a lot of people say, well, there's a lot of tech people getting laid off. Okay, that's true. And guess what? They have 6 months severance and they're chilling and they'll be okay. Construction labor is always the key. Now, when we look at general housing data in terms of employment, the area where you actually see real big losses is in the mortgage industry. Remember, since it's a transfer of commissions in the existing home sales, they're not technically W-2 wage earners. Now, of course, there are people that work for real estate companies that get paid salary. If they lost their job, that's one thing. But here, it's a transfer of commission. More than half the realtors in America don't even do any transactions. So that's not it's a hit to the incomes of those that are still in there. But construction workers we're still hiring, right? It's the permits of the apartments that now are at recession levels. And the key is once those things get built out, they're not building anymore, right? So in a sense, if people ask me, well, why do people say higher rates are inflationary? It's not inflationary now. It's the future production of housing or supply that gets hit. Business investment, right? Thankfully, there's spending going on to build chip plants and stuff like that. If that wasn't the case, right, then you don't even have that aspect of construction workers into the play. So there's a lot of variables that are different in this cycle that we didn't have before. But hopefully, when I write those labor articles, I try to connect the dots going back to April 7th, 2020 to where we are, right? And that's how a model should work. So be a little bit skeptical of people just throwing stuff up in the air and this looks suspicious. I'm like, dude, you were calling a recession in 2022. What looks suspicious to you, right? So just kind of be mindful and let the data talk to you. What do we do in these live events, Sarah? What do we do? I take the FICO score data. I go, people, 8:00 evening. I got jazz music on. I got a bottle of wine. I look at that beautiful FICO chart data we have in America and go, God, that is a sexy looking chart, right? There's a lot of labor data that still is looking good. It's not terrible, right? It's not as good as the FICO charts in America, but we're not breaking. Once it breaks, claims rise, we start losing jobs. So naturally, we're going to slow down on the job growth rate. It's going to eventually get to my level. We're not there yet, but we're heading there. And then the next stage is, unemployment rates will rise because of that. More people maybe in the labor force, less jobs being created. Then we could talk about, how the Fed handles that stage. But we're heading in an area where we could possibly have a soft landing. It's all up to them at this point.
Economic data can feel like you're on, you get whiplash, right? Because earlier this week, we had some data that was seemed like strong, right? And then we're like, and Powell came out. And then we have this data. So You say we're heading in that direction. If you're out there, so it's your dad, he's out there, he's running a mortgage company. How do you make decisions like for the next 3 months, 6 months, 9 months when things are changing so fast?
So we've always highlighted scissors, labor over inflation. I think if you made business decisions on inflation falling and mortgage rates falling and the Fed pivoting, then that didn't work out. We're here trying to talk about follow the labor data, right? Because the bond market will send mortgage rates lower. It's done it twice already. The bond market has priced in rate cuts a few times now, 3 times. The 2-year yield has fallen 3 times, thinking the economy was going into recession or we're going to get weakness or a pivot. They've all retraced back. But the labor data is slowly moving into an area where I think the Fed could feel much more comfortable, right? Labor over inflation. I know the 10-year yield has fallen quite a bit from the recent highs this week. Remember, itchy fingers, right? We talk about itchy fingers at very key levels, volatile movements. So we'll see, but we take the data, one day, 1 week at a time, and we try to make it this big, beautiful, tasty enchilada with all the data and go forward with it because nothing stays static. Things could get stronger, things could get weaker, things get weaker really fast, they could get better really fast. So we'll see. It's very complicated this time after COVID, right? We're dealing with a lot more higher velocity data. It wasn't like the previous decade. Previous decade, boring, very slow growth, very slow wage growth, very boring, not much really going on. A few years we had some drama, but outside of that, here we don't. Here we have crazy stuff all the time. So my job is just to try to make sense of it all, but always keep focused on the labor data. I encourage everyone, go read the HousingWire Daily, HousingWire article on my labor reports. We connect everything, right? Connect the dots so everyone could kind of understand. Here, we're trying to play poker with the Fed on when they would pivot. Remember, I'm not a Fed pivot guy till labor breaks. We're starting to get an area where, boy, they might not need labor to break it to get fully back to make sure the labor market is stable. So we'll see.
We will see. What else are you looking at right now?
Well, right now, of course, the inventory story. Hopefully we get another week of positive inventory growth, 11 to 17,000. What we need now, rates have come down just a little bit, but we're kind of, we haven't gotten to 8%, but we're definitely above 7.25. Remember, 7.25 is the threshold. Last year, 7.25 did not give me the growth of inventory I was looking for. This year so far, 2 for 2. We'll see if we'll go 3 for 3. Right? In that context, demand, our pending contract data weekly is better this year than it was last year. More sellers than our buyers. We have pockets of stress, and just be careful. Do not listen to YouTube crazy people. Okay. If there's one thing I've tried to teach everyone, do not listen to crazy YouTube people. You only listen to people, name, face, forecast. Year-to-date forecast in 2024, 5 years, the last 5 years. If they cannot give you a forecast, if you listen to them, they're playing you, right? You only listen to ball players who want to play. So be careful out there because people have been sending me some YouTube clips and y'all some crazy people. I'm telling, gee, man, how much energy can you guys put into making stuff like this, right? And it's like the same in 2020. It was the same thing in 2014, 15, 16. 17. We literally have someone come on TV and go, sexless men and video game play is the housing crash.
And they call her, I think, didn't they call her the Oracle?
The Oracle of Wall Street.
Wall Street, yeah.
No, absolutely not. And I encourage everyone, just go read Meredith Whitney's housing forecast this year and the last 5 years. I implore you, please go type up Meredith Whitney's housing forecast last 5 years. In fact, all your housing crash people friends, type in their names, see if you get a written forecast. They will give you nothing. You lose, sir, right? Charlie and Willy Wonka, Charlie in a Factory, right? I've done this for so long. I know how this works. You only listen to people who forecast because that's their model. And then if they go with it, they can't keep on sounding bearish. Everyone pay attention to me. The world's coming to an end, right? We had a great question on the dollar, Sarah, right? People asked about, the dollar. And I said, listen, if the dollar collapses, you tell me what city is Mexico going to buy first? What city in New York are the Canadians? Because their currencies are going to all of a sudden explode higher and our dollar is going to collapse, right? We have a lot of privileges here in the United States of America. We are a very wealthy country. We have the biggest military in the world. We have so much. I mean, we're what, $175 trillion of financial assets now, so we have benefits that other countries don't have. If anything, the dollar could get too strong, right? There's so much transactions in dollar dominated out there that, that could be the wrecking ball. But here, man, the notion of the Roman Empire falling, like the US and the Huns invading us, man, we already had a plague, right? We handled that very good in some cases. But look, we survived. We've outperformed the world. There's a reason for this, right? And it's that, what was that chart we had in the conference? The demographic chart, right? We got a lot of people, a lot of young people, replacement consumers and workers. And that's the benefit of the United States of America, and unbelievably healthy balance sheets, especially from homeowners. Renters, different story, but for homeowners, other things to worry about than some of the fanatic syndromes out there.
Absolutely. Okay, we are recording this on Friday, as always. It goes live on Monday. So looking out at what will be this week, if you're listening to this, what are the reports you're going to be looking at?
Well, for me, I really want to see how the bond market reacts now after jobs weeks and the Fed, right? Because, like the ISM, manufacturing data, that came in weaker than anticipated, but the prices paid was higher, right? The Fed has talked about, we're going to slow down the pace of quantitative tightening. We talked about this 6-7 months ago, that can be helpful to the housing market if that occurs. Let's see how the bond market reacts next week, once we've had this really, really big week of not only just job data, but the Fed and everything, and how we move forward with that. It's just one of these things. Every week we got to look at the data and interpret it in a way that where we think the bond market and the Fed is, because that's really what matters is the bond market more than anything else, right? That really controls everything. We said that. Remember that time we went on CNBC? The housing market revolves around the 10-year yield. The 10-year yield runs the show. One good thing, the spreads again are better, right? So much better than last year. I thought last year's mortgage story was really the spreads got really bad after the banking crisis. So far, we haven't had a banking crisis in the sense to make the spreads worse. So that's a positive. But I really want to see how the 10-year yield relax this week after a very hectic week of data and Fed talk.
Reminder to our listeners that so our HousingWire newsroom writes up the reports as soon as they come out. We try to be first. We try to get up there. So, all the housing reports they're going to write up. Then Logan comes in and does analysis of all of those reports on the same day. So you can get the news that just happened really quick, and then you can get the analysis. And then every day he updates the Mortgage Rate Center with where he thinks mortgage rates, how the 10-year yield is working that day, where he expects mortgage pricing to be. So we update that every single day. So all those things are resources if people want to go look at them.
We can't wait for more of the nerd tour to happen. And again, always be the detective, not the troll, right? Trust me, one of my jobs is to fight as many trolling crazy people as much as I can, but I have to do it with data. I can't do it with my hair. That wouldn't work. I would just destroy everyone at that.
Okay.
In any case,
we're going to have to break out the Logan Mohtashami bingo phrase cards again, because in this one podcast, you have said Peloponnesian War. You said be the detective, not the troll. Also, the way that you say comfortable, you say it in like four syllables. I'm sure that's the way you're supposed to say it. But like I always say comfortable. Like it's short. You go comfortable. So anyway, we're going to have to break out.
I'll tell you this, for anybody who runs a company, a real estate, mortgage, Wall Street, I'm telling you, the live presentations are a lot of fun, right? But they're a lot of fun, but they also go into the nitty gritty of details and economic cycles and how it works, right? Remember, economics done right should be very boring. It's not decided to be this hot, fun, sexy thing or kind of, really headline grabbing attention. But you can do it in a way that it could be entertaining and accessible to everyone, right? If I do my job right, all of you can finish my sentences. You could do bingo cards because you know what it's going to say. We stay consistent out here. And it's been so crazy with data. The velocity of data is so wild. And this cycle is so unique that you have to kind of go with it, right? The waves aren't going the way you usually think it is, and you have to be very flexible. But that means you have to be really religious in following the data every single day, every single second.
Well, Logan, we appreciate that you are doing that for us so that we can read your stuff and listen to you and find out. We will talk again soon.
We'll talk again. And we went to a country event. Country music was wonderful, great, right? And they led me off with.
You knew none of the country music.
I didn't know, but it was very entertaining. It was good. You know, I had a lot of country women tell me my hair looked great and I should never wear a hat. That it would be a crime to wear a hat with this kind of hair. So.
Yes, but let's be clear. We're sitting in the Grand Ole Opry, and you didn't even know what the Grand Ole Opry was. I was like, "What? Who are you?"
Hey, listen, Bob, but the music was great, so
it was
fun.
All right, we'll talk again soon. Thanks.